welcome to another episode of Taking Stock. This is the show where we prepare you for the coming week and analyze the week gone by. I'm Sonia, and as always with me is Anuj. This week was a very disastrous week for the market, if you want to put it mildly. In fact, the Nifty was down, about 6% in the last 2 weeks now. And we've seen some negative earnings as well that spooked the markets, not just Infosys. We had the likes of Wipro, Ken. So clearly the market is in a serious bear grip now, Anuj. But if you look at it from the top, it's still not a 10% correction that we've seen so far.
Indeed, Sonia, it's not 10% correction, but I think the Nifty is masking a lot of pain, actually. If you take a look at the broader market, and not at the index level, if you take a look at stocks, like, for example, like Sun Pharma Advanced Research, stocks like Symphony, some of the high pedigree stocks like Bata, Apollo Tyres, TVS Motor, a lot of these stocks are down 20, 30, in certain cases 40% from the recent highs. Just Dial is another example. So I think, yes, it's still a big bull market which is going through a bit of correction. A lot of people may want to say that maybe a near-term, just a near-term structural bear market within a long, or cyclical bear market within a long structural bull market. But in individual stocks, the pain is now there, and that's where portfolios are hurting. And I tell you, the earnings season, while a lot of people had said that the bad earnings season has been priced in, the earnings are worse than the worst of the estimates. And if this is what the front benches have done, you will shudder to think what the back benches will do. And this really will go down as one of the worst earnings season. Next week is expiry. Expiry weeks are about momentum. But at some point, this market is going to become a screaming buy. But don't know if that point has come yet.
All right, let's pose that question to our first guest on the show. We have Sanjeev Prasad of Kotak Institutional Equities who joins in now. Sanjeev, hi. Thanks for joining in on Taking Stock. It's been a very disappointing week for the market, not just this week, but the week gone by as well. What are the places to hide in this market, or do you think the best thing to do would be to up your cash levels now?
Yeah, hiding places are somewhat tricky to find because if you look at the traditional defensives, such as the consumer pharma names, they are pretty expensive. You look at any decent frontline consumer staple stock, it will be trading at more than 30 times March 17 numbers after building in 2 years of growth in March 16 and March 17. Similar, you have seen for pharma, and you have seen the way pharma stocks have corrected over the last 7-10 days. Just given a little bit of miss on earnings expectations over there. Similarly, IT could have been a defensive. I think at current levels, maybe the worst is there in the stock prices, I would assume. Whatever cross-currency impact it's had to be felt in this particular quarter seems to be there. So maybe that is one area you could look at more strongly now that we have seen a massive correction in the stock price over the last, again, 7-10 days over there. The other one you could look at is private banks, which haven't done much over the last 3 months. They have been in a range. In fact, ICICI Bank has come down about 15%, down probably about 15% on a calendar year-to-date basis, trading at about 1.92 times March 16 basis. Axis Bank is about 2.5 times. So I think there the valuation started to look a lot more reasonable, I would think, and they could act as defensive. So, over the last 2-3 weeks now, we have also been pretty worried about the market. We have been highlighting our concerns, searching for some sort of hiding places. That's one of the reasons why we increased the weightage in some of the stocks such as ITC, Reliance, which were very big underperformers over the last year or so. But they have done their job, but obviously the others which we were looking at as good defenses, they have actually corrected quite significantly now.
Sanjeev, hi, good to have you on the show. You speak to a lot of these FIIs. What's bothering them? Because if you were to adjust for the Sun Pharma deal, you've seen quite a bit of secondary market selling, and that's impacted the currency as well. Do you think this is the MAT issue, the earnings issue, or just normal routine profit taking, no more, no less?
No, I think it's a combination of several things. The first thing is, the expectation which were there that India will start seeing an economic recovery, 2-3 quarters after the formation of the new government, that is not coming through. And every company you speak to these days is talking about a recovery maybe 3-4 quarters down the line. So clearly, FI investors are taking a somewhat negative view on that. Patience is running out maybe to some extent. Linked to that is the fact that you are constantly seeing earnings downgrades. If you look at fiscal 2015, for example, at the beginning of last year, around April 2014, We were looking at somewhere about 15% growth for fiscal 2015, net profit growth for the BSE 30 index. That's come down to about 2%, and I suspect by the time we end the result season, it could be pretty much flat. Accordingly, 16 numbers, I've also got downgraded. So clearly, earnings numbers are not coming through, and the market is looking expensive with every cut in earning numbers. Third point is clearly, you had seen a big re-rating in the market. Valuations had gone up significantly on expectations of earnings coming through. And of course, now that earnings are not coming through, the valuations are no longer supported by earnings in that. So obviously, the valuations are giving way to some extent. The final points I would say is more linked to global macro and also what's happening in other emerging markets. The problem is many of the other emerging markets have started to do very well. India is, in fact, if you look at the last 1 month or last 3 months, India is probably the worst performing emerging market. Year to date, in fact, it's negative now, whereas a lot of other markets have given pretty decent returns, in anywhere from 10 to 15% in some cases. So there could clearly be a rotation happening out of India. 3 months back, all of us wanted to believe that India was the only good emerging market to be in. That's clearly not turning out to be the case. And finally, all the MAT issue, etc., forecast of weak monsoons, all that has clearly affected sentiment. So on the one side, you had expensive valuations, downgrades in earnings, economic activity not picking up. That's the more fundamental reasons for the correction which we are seeing now. And secondly, you have some amount of technical issues also, in the sense people are starting to look at other markets more favorably compared to India.
So, Sanjeev, anecdotally, this market, has kept rewarding some of these high-quality names with high valuations, except for the last 2 or 3 months. Do you think that that's still going to remain the case, and that's why maybe some of the pharma names could have become a good buying opportunity now after the kind of correction that we have seen? Or do you think that we have reached a stage now where valuations will begin to matter quite a bit?
No, clearly your second point is absolutely valid. Valuations will matter. What had happened over the last 6-9 months was that many of the stocks were really not running on fundamentals. In the sense, many of the stocks just got related upward without any real change in the earning numbers. If you look at any of the consumer names or the pharma names, I don't think we have seen any real earnings upgrades over there. But the stocks got related, anywhere from 30 to 50%. So there's no real underlying logic for the stocks to have gone up so much. But now that the stocks have started correcting, people have started looking for reasons as to why they are correcting. When they went up, nobody really questioned why they are going up in the first place. So I think a lot of this entire rating was driven by, obviously, one thing is expectations of a quick turnaround in the Indian economy, which will lead to volume recovery and so on and so forth, which is clearly not coming through. People have started to question this whole recovery in India, etc. The second thing which happened was clearly a global trade where you saw very low cost of money everywhere, a lot of money being printed up out of Bank of Japan and ECB, which had to go somewhere because the yields were very low everywhere in the world. So people started giving very high multiples for essentially the same earning numbers. And now, since people have started to recalibrate the earnings growth in India, the economic activity recovery in India, reforms process, etc., certainly you will start seeing the multiples starting to correct to more rational levels. So if you ask me whether the correction is done in the high quality names, the answer is probably no. You could see some more correction in the likes of all these consumer staples and pharma to more rational levels.
Okay, on that cautious note, we'll let you go, Sanjeev. Thanks so much for joining us and talking about the markets. We'll see you again later on. That's the word coming in from Kotak. Expect perhaps to see more downside as we start to get uglier numbers in the second half of the earnings season. We'll take a break, but before we do that, let's listen into some market opinion that we heard through the course of the week.
Two things that are going to be quite critical now. One is this earnings season, and up till now it has been reasonable, barring some hiccups on the IT side where we have had a little bit of stumble. IMD forecast yesterday is going to be also equally critical because one bad monsoon probably we can handle, but also do be aware that the IMD has spoken of a 1/3 probability of it being a deficient year this time around. So as your updates start coming through maybe month and a half down the line, And if there is two back-to-back really poor monsoons, then I guess it could be a little tough in terms of, you know, rural offtake, various other things, even in terms of the government response as such.
The sentiment for a country like India is fairly positive. You've got money which is on the sidelines, whether it's a domestic investor or even on the foreigners waiting on the sidelines, waiting to look for a market, for an opportunity to invest into the country. So the focus needs to move away from valuations. The focus needs to move on how companies will execute over the next 2 or 3 years. And the opportunity is actually to find these kind of companies that can execute well into the environment. We don't really think that the market will be cheap even if you get a correction from this level in 2015.